Good afternoon. Uh, I hope everyone is well. And today's a Sunday, and I'll be doing a trade review on Friday's trading on 6th of March. And yeah, I do hope we find this well, and I do hope you learn something from it. And yeah, so I'm gonna just go on, get straight to it. So currently, right now it's 11:30, and you do know what conditions are placed 11:30, right? It's the lunch macro. So I'm trading in the context of lunch macro from 11:30 till what time is this? Half past one, 13:30. All right. And so the whole context of the trade is to sort the inversion fair value gap that's shaded in orange. So I'm sorting this with the context of it staying below that consequent encroachment, right, and getting down to that lunch macro south side liquidity down there. But what I wasn't mindful of is the fact that we had liquidity above there. You see that static liquidity, that trend line liquidity above market price. It's too smooth. So I wasn't watching that. That was one mistake I made in the trade. I wasn't watching that. And so if I had watched this, I would have been insightful that it might probably try to get up there. So I should have just waited for a moment before getting in this marketplace and just shorting straight up. And so this is me shorting it. And as you can see, it just traded down below the lower half, the consequent encroachment, excuse me. And so it's kind of staying inside that range, and I'm trying to figure out what the next candle is going to do right now. And before you know it, it trades back up above that. It's not supposed to do that. If market is exceedingly bearish, it shouldn't take out the high of that inversion fair value gap. It should stay below the low half. It's playing too much inside of the upper half. And so that right there wasn't a good signature. And so chances are I was probably going to get stopped out. And so the moment this candle closed above that inversion fair value gap, it kind of threw away the whole context of the trade. So it was a losing trade from the moment I took it. But then I was wary of the south side liquidity, so I submitted to the idea that it'd probably try to get up to the south side liquidity or that static liquidity, the buy side liquidity. They were probably going to try to get up into that and take out all those buy stops and accumulate that. But you see, I got stopped out right now. All right. But that doesn't mean that the context of the trade has shifted. It doesn't mean that lunch macros conditions aren't in place. The idea is still in place. It's just that I got in the wrong timing. You understand? And so now I'm grading the sell side imbalance, buy side inefficiency. So those are the two horizontal vertical lines. Yeah. Some price is currently trading up into it. So that's me denoting the sell side liquidity, the buy side liquidity, excuse me. And that was way too smooth for them to leave it out. So if I had been aware of that, I wouldn't have taken that trade. But yeah, that was the wrong timing. And so if you may notice that there's a blue shaded area, blue rectangle, this is large blue rectangle. So that is the opening range gap. So from regular trading hours settlement price to regular trading open, that gap is a gap that has been left unfilled. So it did trade into the gap, but the blue shaded area is part of the gap that hasn't been filled yet. So it's a regular trading opening range gap, unfinished business. So they might try to get up into it and do something with that. I don't know. But at this point, it's too much of a premium. It's too expensive. And so I couldn't think for one reason that it would try to get up inside that gap and try to fill the entirety of that. It didn't make sense that they would do that to me at lunch macro sell side, because lunch macro goes against the narrative that was in place during the morning session. So if you may look to your left hand side, 11:30 till 9 o'clock, what was going on? Prices were going up, right? Prices were surging up. The only individuals who were profitable were the ones who were long, right? And so it makes sense that during lunch macro, it will go against that narrative that was in place in the morning session. So it will try to take out sell side liquidity, buy sell stops. That's the whole context of what lunch macro sell side is. And so the idea hasn't changed yet. I think at this point, it's still the same thing, still the same conditions. It's just trading it up at a premium, taking out sell stop, accumulating buy stops above the marketplace. So I'm just trying to get a whole context of the bias and narrative and what price is doing right now. So I'm on a higher time frame. And you can see how perfectly you use the new week opening gaps, the quadrants and everything. That was really perfect. Especially here. You see that? That was beautiful. That was literally to the tick, using the daily SIBI, consequent encroachment, and rejecting right off it. I think that was really perfect. And so at this point, my thought process is that they'll probably try to give us those lunch macro lows, the south side liquidity around macro time. So that will be the time period of 11:50 till the first 10 minutes of 12 o'clock. So 11:50 till 12:10. That's when I think they'll try to do something with price. There might be something of significance that may happen in market price. They may take out buy stops, offset buy stops, and then start delivering that sell side program. Excuse me. And so that was the whole thought process of this trade at this point. So that's what I'm waiting for, the lunch macro. So I'm not doing anything up until the lunch macro. And I'm on US 500, on S&P 500, trying to get the idea of whether we had an SMT divergence or anything of that sort. Whether there was a cracking correlation. There wasn't. By the way, there wasn't any of that. So there was minus sell side liquidity, right? So in the reason that I thought that price wouldn't gravitate up higher is the fact that we had minus sell side being built up in the form of relative equal lows. So what's going on there is because of that, there's buy stops being trailed below those lows. Excuse me, sell stops, I mean. So in a scenario of minus sell side, you would say there's sell stops resting below those lows. So retail, what they'll do is, or let's say smart money, deep pockets, they'll trail the stops below those minus sell side liquidity. So what's that building? What's that engineering? Buy stops. Sell stops, I mean. So with that idea in mind, it didn't make sense for me that price would try to gravitate up higher and leave those engineer liquidity and then leave that. It doesn't make sense to me that they would try to do that. So the only thing that was true is that price would try to build premium, take out buy stops, gather liquidity, gather enough liquidity to end up injecting that liquidity in the marketplace at a specific time, because that's what the algorithm refers to: time first, then price. Build price at a premium, and then release, let all hell loose at macro time. If they don't do it at macro time, then what macro is going to do, they're going to stage for that scenario to pan out. They're going to take out buy stops. They're going to see setups form at macro time. The move may not happen necessarily at macro time, but that's when they're probably going to start staging for it. That's when you can see some signs of, accumulation or distribution. In this case, we didn't get that move specifically at macro time. We did get some sort of reaction happen at macro time. There was some sort of displacement to the downside. And so, okay, that was a sign, basically price showing us its reluctance in gravitating up higher and getting up at a premium prices. Because it was already priced at a premium, it's already too expensive. So now what we're seeing here is premium sensitivity inside of that opening range gap. So you would have seen it if I graded the quadrant levels on that opening range gap, because it was kind of a large opening gap. That was a really large opening gap. So this whole range that we're in right now, this whole price action is basically inside of a gap, a large black hole that hasn't been filled. So the blue rectangle, the blue shaded area, that's part of the gap that hasn't been filled yet. You understand what I'm saying? We above the regular, it was a discount opening gap. Let me not confuse you. This was a discount opening gap range. We currently above the regular trading open. The discount opening range gaps low. But we haven't completely filled it yet. There's part of a gap that hasn't been unfilled. What we call that is a unfinished business. That's price. It hasn't done the complete job of completing that gap. And it's probably not going to do it. If it hasn't done it yet, it's probably not going to do it. It's lunch macro time. It has to go against the bias that was underway in the morning, which was the dudes who were making profit was longs. So if it's going to go against that, what is it going to do? It's going to target sell-side liquidity. It's going to go against that. It means it's going to gravitate lower. We're going to see lower prices during the time range of 11:30 to 1:30. That's the lunch macro. That's the whole concept of lunch macro. Do you understand what I'm saying here? So it didn't make sense to me that price would gravitate up higher. I didn't want to see that. If anything like that happened, I wouldn't be part of that move. And I wouldn't feel like I would have, I missed the move. I wouldn't have that feeling of, fuck, I just missed the move. Because that was not my move. That was simply not part of my move. That wasn't my plan. You understand what I'm saying? So it's like, bro, that's not what I was expecting. I want low prices. I don't want to see high prices. Why would I take something that I don't want? You understand the logic behind that trade? So that's exactly what's going on here. So me being stopped out in the first trade, it didn't mean the bias had changed. Okay, now everything changed because I got stopped out. Oh, fuck. That means I have to change my bias. Oh, the day, no. Think about what's happening here. Think about the time. Think about where price is. You understand? Think about what price is yet to do. And then you can gather all those concepts together and frame a narrative. And that's how I was able to determine this bias. That's how you determine a bias. You understand what I'm saying? So let me just play the video for you right now. So those lows, I'm trying to see if whether they take them out or not. The lows that I just graded right now, that that imperfect trend line right there, those are lows. Those are relatively good lows. And what's resting below that, there's a bussy resting below that. That's a buy side and sell side efficiency. So I'm trying to see whether they'll try to fill that. If they don't fill that, if they don't take that low out, then that probably means they'll try to guarantee it high. They'll probably still try to build it up at a premium. And then at this point, this gap, the horizontal vertical lines, that gap is probably going to fail. And then now my next suspect is this high. Then they're probably going to try to get up in that. But again, that doesn't mean price is going to go up. That doesn't mean because they took those lows out, we're going to see higher prices. All of a sudden the bias changes and now it's bullish. No, it's not. It's simply not bullish. You understand? So that's my thought process behind what's going on right now. That's what I'm watching. So now I'm watching to see if they take out this low. And in the way they do it, I want to see them hold price. I don't want to see them take that low out with so much, energy. I want to see extrapolated moves above that high. Because then what that means, I'm wrong. Then that probably means that we'll probably see higher prices. Then it's probably just going to try to fill that entirety of that gap. But obviously, I know what I'm doing. I've experienced, I've seen this, I've tape read hours and hours and hours of these things happening. And so I know the logic behind this. It happens every fucking day. Every day. This type of thing happens. This lunch macro thing, it happens. These conditions are always in place. So I know what I'm doing. I'm confident. I know what I want. I know what I'm looking for. That's how I'm able to frame a bias and be able to take losers and still keep that same bias and still execute on the same bias. I was stopped out on first trade. For example, on this one, I was stopped out on first trade. But did that mean I had to change my bias into longs? No. I still stick with it because of these type of conditions in place. So I was saying is, I want to emphasize on the fact that if price takes out this high, right? And in the way I want to see price take that high out is I want to see price holding it. I don't want to see extrapolated moves above it. I don't want to see these bullish candles, this large surge in price action above those highs. Because then I'm wrong. But what I do want to see is price taking those highs out, but then holding it. I want to see the algorithm or whatever that is that's controlling price. Okay, it's not VWAP. This is not support and resistance. Okay, understand this. This is not support and resistance. These markets are based on an algorithm. These markets are rigged, they controlled, and they operate under a certain coded. They're obligated to do certain things. It doesn't matter the amount of buying pressure and selling pressure that comes in the marketplace. Price is going to do what it has to do because it's coded. Before market even opened, it's coded to do certain things at specific times of the day. And so these are one of the things it's coded to do, my friends. The launch macro. And it works every fucking time. It never fails. I'm not saying here that price has to do exactly this thing. Go against the bias. Go against what happened in the morning session. It's not going to do it every day. Understand this. Don't get me wrong. It's not going to do it every day. What launch macro does is it allows for price to go against. Mind you, emphasis on allow. It allows for price. It doesn't have to do it at launch macro. Do you understand that? It allows for price. That time range, that 11:30 to 1:30 p.m., it allows for price to relax. If we had a large extrapolated daily candle, launch macro is going to offer that period of relaxation. Price is going to relax, go against what was going on, give us some sort of pullback. You understand? Build discount prices. If the entire narrative is to see high prices on, let's say your daily bias is to see high prices on NASDAQ, right? And on this specific day, on Friday, we had a large extrapolated a daily candle, which is bullish. When 11:30 hits, the price It's going to go against what was happening, what was transpiring since the morning session, since the opening bar, which was 9:30. It's going to build discount price. It's going to give us a pullback. And so those are the conditions that are in place. Why I say that I believe this is a suspect rally. A suspect rally means it's a fake rally. It's an enticing rally to retail. It entices retail to get in long, to think that it's going higher. Because mind you, what retail operates under is, remember this, retail operates under the logic that when we see price breaks highs, like this high for instance, price just took that out. They're going to take that as a breakout. That's a breakout, some sort of breakout structure, which we know as the ICT guys. That's not a breakout structure. It's not. It's a fake out. It's for the retail. It's to entice retail to get in longs. So smart money is going to gather all those long positions. It's going to gather all those long positions, and then it's going to offset them during at a specific time, which is lunch macro, guys. You understand that? You understand where I'm going with this? It's rigged. That's why retail feels like every time they're being targeted. They're not being targeted. They just have this, they're ill-taught. These are ill-taught individuals. They watch 5-minute trainings. They think they know everything about markets. Breaker structures, view-ups, all those kinds of things. You name it. Those things don't work. They don't work against the algorithm that's coded to do certain things. Price doesn't operate under volume imbalances. I mean, what do they call this? What do they call this? Volume profile. Fuck no. It doesn't work under that. You think the amount of buy market phase are going to affect how price moves? The amount of retail buy? No. Price doesn't operate on those bases. It's rigged. It's controlled. And that's about it. Because if it wasn't rigged, no one would be profitable. And that's what ICT emphasizes on. Right? That's what ICT emphasizes on. If you want to understand this concept better, go to ICT. You have to watch the video. If I sound very boring to you, go to ICT's channel. It will tell you everything about the algorithm because that's the author of it. He's the author of all this. I'm just using my channel, different voice, some sort of different conduit of his concepts. And unless you don't like his concepts, his videos, maybe they're too boring because I found them boring. Everybody finds them boring. They're boring. He even says it himself. They're boring. His concepts are really boring. The videos are long and boring. And some people in this generation of ours, this everything, they don't seem to have that attention span. Attention span is a 5-second attention span here. So though act as a different conduit, you understand what I'm saying? As a different voice to teach his concepts. But I invite you, I don't mean to take away his audience, as if I would be able to do that anyways. I act as a different conduit to teach his concepts. Unless if anyone doesn't like his videos or they don't find them too attractive, well, here I am. I'm teaching them right here. So you have no excuse not to learn these things. Because I do want people to learn this. I think it's very fucking good. And I think everyone should know this. It's just too good. It's too fucking good. It's too fucking perfect. So yeah. And watch that. It's lunch macro right now. Mind you, this is lunch macro. It's 11:54. What's that? That's a displacement, right? You see how it took up that high? You see how it took out this high? But then it immediately came back inside the range. And watch how it took it out. We only see wicks above it. But look where the bodies are closing. The bodies are closing back inside the range. They're not closing above it. That's premium sensitivity. That's premium sensitivity. Look at how it's going. You see what it's doing right now? You see that displacement? That's confirming that it does not want to go up higher. It's not. It's simply not doing that. And so that's why I say it was a suspect rally. It was a fake, enticing rally, enticing retail to go in longs at the break. To what? To build orders, to accumulate and gather orders in the marketplace. And so that's what it was. That's simply what it was. And so that displacement right there confirmed to you. That should tell you right there that, hey, look here, I'm going low. I want to go lower. I want to see lower prices because I'm too expensive right now. I'm priced at a premium and I want to go lower. So that's the sign right there. That displacement confirmed that. That confirmed the sell side program. And so I'm not doing anything just yet. I'm not doing anything just yet. I'm still waiting for some sort of signs, some sort of signatures of weakness. And so now that we have that bearish fair value gap put in place, that's sell side imbalance, buy side inefficiency, because that's what it is. A bearish fair value gap is a sell side imbalance, buy side inefficiency. So it's inefficient in its buy side delivery. The whole concept of name is the candle is inefficient in its buy side delivery. It offered sell side, but it's inefficient in its buy side. Do you understand what I'm saying? There was no buy side being offered in that range, in that down close candle. There were no buy orders. If you wanna, understand that way. And so you see how reluctant the price is in gravitating up higher. You see how weak it is. You see how it's giving you its hand. That's the whole compendium of ICT's concept. That's what it teaches, being able to read these candles, not fucking patterns. You don't read patterns. You read the candlesticks because that's what tells you the story. That's what tells you everything, not candles. Not patterns, I mean. That doesn't teach you anything. VWAP, who uses those things? Those things are very archaic. They don't work. In today's price action, in today's volatile moments, they don't work. They simply don't work. So now we've obviously seen the signatures that were in place, right? We had those highs. Remember those highs I was talking about right here? When they took that out, it was reluctant in its buy side delivery. It was weak. It was exceedingly weak, so we couldn't even see bodies closing above this high. And that was a signature of price telling you that it wants to go lower. Okay. And then we had this displacement that confirmed that this sell side program is coming. Anytime soon, this sell side program is in place. It's going to be in place. Alright then. Now we have this new high right there. You see that high? That's our new high. Okay? What are we doing here? Notice what we're doing here. We have this high here. We have these smooth highs. See smooth relative equal highs? What are they being done to? Excuse me. What is happening above those highs? Price is making them jagged. Price is very sharp above those highs. Like it goes up, takes the highs out. We have this sharp high, gets back inside the range real quick. Real business. It doesn't spend much time above those highs. That already should tell you that it's weak. It's exceedingly weak, and at this point, it really wants to get down at this minus sell side liquidity. And the ultimate point would be, the ultimate sell side liquidity would be the launch macro sell side right there. Right? So at this point, it's really weak. It's making highs jagged. It's not spending too much time above highs. Same thing for this run up here. When you had this run up here, you see this? And then you took that high out. That was macro time. That was happening specifically at macro time. And that was the last move above buy stops. That was the last move targeting buy stops. And at this point, smart money has already accumulated enough buy orders in the marketplace. And now what it wants to do is release its sell orders. The real move, that's when the real move is going to take place. Then what happens? You take this high out with real fast, and it doesn't even spend much time above that high. It takes out with one candle, and it comes back inside the range within 1 minute. And then look what happens. Boom. What's that? That's a displacement, right? That's a displacement. That's that sell side program. That's that heaviness in the marketplace. You understand that? That's that sell side delivery. Towards what? Towards minus sell side. What do we have now in place? A sell side imbalance, buy side inefficiency. That's the bearish fair value gap right here. Okay, let's go on with the video then. Now I know, I'm very confident. At this point, I'm very confident that this is going to pan out. The scenario has already been put in place. And at this point, it's almost impossible for me to see price go against this bias. I don't see that happening. That's how you determine high probability. High probability is when one of the two possibilities. So I'm saying high probability markets. So we need to understand this. What is a high probability market? What do we mean when we say a trade is high probable? What do we mean when we say that this bias is very high probable? Meaning that it's going to work out in my favor. There's high conviction in this trade, in this bias, and I have full confidence that this is going to pan out. How do we determine those type of conditions? Well, high probability market is when we have two scenarios that could pan out, which is we both, everybody knows what those two scenarios could pan out. Markets either go up or down. And so for me to say that a trade or a bias is high probable means that it is very difficult to frame the other side of the market going against what my trade idea is when it's high probability. Do you understand that? How do we determine that? High probability markets are determined by the absence of one of them being true. Do you understand what I'm saying there? Do you understand how I differentiate high probability markets and low probability markets? And so now on the other side, low probability would be me not being able to determine whether price is going to go up or down. It's when I don't have full conviction on one of the sides being true. Meaning that it's 50-50. It could go either side. Do you understand that? It means that price could go either side. At this point, I'm confused. And at this point, my bias is very distorted. And so what would you do at that point when it's low probability? You will wait and sit down and sit on the sidelines. You don't want to do anything. You do not want to do anything when it's 50-50. Because chances are you're going to get screwed. You're going to get screwed in the ass. And it's not going to be nice. It's going to be painful. It's going to be really painful. So I need you to understand that. So at this point, I'm creating the macro. That right there. Those buy starts being rated right here. This all here, that's macro time. That's all happening during macro time. At a specific time. You see how everything just falls back to time? That's algorithmic. Everything is framed. As I said earlier on, everything is programmed. These markets are programmed. They're scripted to do certain things at certain times, specific times. And these are the times that I'm showing you macro time. What is a macro time? It's the 10 minutes on top of the hour and first 10 minutes of an hour, of the next hour. So, for instance, at this point, the macro that I just graded right now, that's the 11:50 to 12:10 macro. So it spans, it's a 20-minute time span where markets either seek liquidity real fast or trade setups form around those times. So that's exactly what was in place here. We're seeking liquidity pools real fast. And we had that sell side program being delivered with that displacement. And so at this point, I have a bearish fair value gap. A bullish fair value gap that price is currently inside of. And I'm shorting it. Do you understand that? I'm shorting it with the idea that price is probably going to inverse this fair value gap. It's probably going to act as an inverse. It's a bullish fair value gap. So when I say it's going to inverse its role, it's going to close below the bullish fair value gap and then come back inside of it and reject off it. So that's an inverse. It's inversed its role. It's inversed its original characteristics. Do you understand that? You understand where I'm going with this? So that's exactly what an inverse is. And so that's what my trade is framed on right here. I'm shorting that. And I'm setting my stop at a previous high right there. So now I'm currently trading. I've trailed it basically up higher at that fair value gap's high. Right there. That's that Silby's high. So that's where I've trailed my stop right now. And obviously my target, my terminus point, is this lunch macro side liquidity, resting at 24,724.3. And so now I've trailed it back to where it was originally, this low right here. The reason being is that this gap, this displacement, this was the displacement price leaving an accumulation zone. So price had already offered buy side and sell side delivery when that gap overlapped. That gap is overlapping with the range that has already offered buy side delivery. And so what that is, we call that a breakaway gap. A breakaway gap is supposed to stay open. It should not fill. And so that was my idea at this point. And so I'm trusting that this gap right here, it stays open. Because if you can look to your left hand side at this displacement, at this down close candle, look to your left hand side, what do you see? You see buy side delivery. You see price has offered buy side. It's going up. It's offering buy side delivery. And then it's going down back inside of that same range. It's overlapping with that same range to the left of it. It's offering sell side delivery. So it's offered both sides of the market. And so at this point, it does not need to get back up inside that range. It doesn't make sense that it has to do that. And so that's why I'm denoting that I trust that this stays open. That's the logic that I'm using. But obviously, as I go on and forward, it does go up. It takes me out. It starts me out. And so I believe that at this point, price is still trying to gather buy stops. And so I do end up getting stopped out. It does get back inside of that range. And so I was wrong at that point. But remember, you see right there, I got stopped out. But remember, changed. The trade hasn't changed. None of it has changed. You understand that? Same conditions are still in place. It's still lunch macro sell side. Nothing has changed. I haven't seen any signatures that price is going to go against this, that price might just go up and not take out the minus sell side liquidity pools and the lunch macro sell side. I don't have that place. I don't have those conditions set in place just yet. And so now you may obviously see that it rejected off the sell side imbalance up, buy side inefficiency. Guys, am I making sense here? I don't know if I'm making sense. I think I'm going too fast. If I'm going too fast, please do comment below so that I know next time I go slower. Because I think I'm going really fast. Let me just slow down a little bit. Price had rejected off the sell side imbalance, buy side inefficiency. So that's the yellow shaded area, that rectangle. That's when it started me out. So it rejected off that. But mind you, it's staying below consequent encroachment. What's that denoting? That's denoting weakness, right? Obviously, when price is reluctant in its buy side delivery, you would expect it to reside in the lower half of that bearish fair value gap. And so that's exactly what it was doing. The bodies are staying in the lower half. The wicks are very much permissible to do the damage. They are allowed to go above the consequent encroachment because that's just fluctuations in price actions. That's just volatility in the marketplace. We call those mohawks. The ICT students, the guys who know ICT like that, the guys who follow ICT, we call that mohawks. So those are imperfections of the marketplace. As you may know, markets aren't perfect. They don't reject and support right off the price levels, right? They have to have some sort of fluctuations. And so obviously we have seen this displacement below this bullish fair value gap, and so now the characteristics that are in place is that it should reverse its role, as I said earlier on. And so we have a sell side imbalance, buy side efficiency put in place, right? And so I've set my sell limit at the consequent encroachment of the premium wick. So this right here, this down close wick, see that wick? So I've graded from the high to the low. I've graded the halfway point, the midpoint. So that's consequent encroachment. And so that's where I've trailed my stop loss, because the idea is that it should stay below that consequent encroachment. And so now I've taken partials again. Oh, excuse me, not partials. I've added on my position. I've added 5 contracts. I've added 5 contracts above that consequent encroachment. And so the idea, the logic is that it should stay below the low half of that orange shaded area. So below the consequent encroachment of that orange shaded area, it should stay below that. Again, that's indicative of weakness in the marketplace. It's indicative, it's denoting heaviness. And so mind you, notice where I'm setting my stop loss. So that's another important thing. That's another important thing that you notice. My stop is placed above this down close candle's high. You see the down close candle that comes with an efficiency? I'm setting my stop right above that. It should not by any means necessary go up to that high, because if it goes up to the high, if it goes to my stop loss, that means I'm totally wrong. And at this point, I would stay on the sidelines. And at this point, I won't force my bias, because it's obvious that at this point, it doesn't want to do this. It doesn't want to offer this outside program. And so I would stay on the sidelines. But obviously, that's not true. Price is staying below that lower half as we expected it to. That's weakness. So that's exactly what I want to see. And so the low-hanging fruit objective right now is this minus outside. Those relatively close. That's the low-hanging fruit objective that I'm watching out for. And so I'll be taking out partials below those lows, I think. Right there. That's what you want to do with every position. You want to take partials. You want to make sure you get something out of the trade. You strangle the trade as much as you can. You squeeze the juice out of that trade as much as you can. Get something out of the trade. Your target may have not been reached, but you have to have something to hold on to cover costs, to cover commissions. So that's exactly what I'm doing. I've taken out partials below the minus outside liquidity, and I've trailed my stop loss to the previous high right there. And so as it gets down closer to my target, I'm taking partials once again. Squeezing the trade, squeezing the juice out of that trade, getting as much as I can out of that trade. You understand that? So at this point, I've taken out, 4 contracts. And yeah, I feel safe right now. Even if it can go against me, I pretty much don't care, because I've covered costs, I've covered commissions, and I've taken a win already. And so now I'm relaxed. My psychology wise, I'm not stressing over this trade anymore. My stress level has gone down significantly, because now I've taken out something. I have something to show for. Once again, squeezing that trade, taking out 2 contracts. That buy limit, that's a partial. Specifically set exactly at that volume imbalance. You see that separation between that candle's low? You see this down close candle? Watch this down close candle. This range down. That range down and its close. Watch how its close is not overlapping with the next candle's open. See that separation there? That's the volume imbalance. So I'm setting my buy limit at that volume imbalance high right there. So there has to be a rhyme and reason as to why you take partials and where you set your buy limits. Everything has to have a rhyme and reason. You can't just randomly just set targets wherever you feel like, you know? Everything has to be a rhyme and reason behind it, you know? Same thing here. That separation between this displacement, this up close candles close, and the next candle's open, that separation, that's a volume imbalance. Price is likely to get down there. It's gonna get down there because there hasn't been any buy side being offered. It's an imbalance in its buy side, so price has to get down there. You understand the logic that I'm using behind these trades? It's really simple. It's not complicated. It's really simple. And so boom, that's another partial taken out at that volume imbalance high once again. And so at this point, I'm safe to say that I can trail my stop loss, you know? I don't see any reason why it will get up all the way up there. Even if it does, I pretty much don't care because I've taken out as much as I can out of this trade. At this point, I've taken out 6 contracts already. I've taken out a majority of the trade. And so now I can trail my stop loss to the previous high, which is this SIBI, that down close candles high. That's where I'm trailing my stop loss. Once again, everything has a rhyme and reason. Everything has a, logic behind it. So my target, my terminus point is that launch macro sell side liquidity. And so what we had in place here, when we had this down close candle with that imbalance, that sell side imbalance inefficiency, the bearish fair value gap, when we had that, price traded up into it. But notice how it does that. It does it with a wick. It doesn't get inside of the range and close inside of it. It doesn't close the entirety of that range. Instead, we only see wicks. We only see wicks pierce inside of that. So that again indicates, and so we call institutional order flow entry drill in terms of market, in terms of ICT's concepts. That's an institutional order flow entry drill. So those are the abbreviations. That's weakness. And so it's kind of a feedback that I'm still in the right place. I'm still in the right side of the market. It's a signature of weakness. That's what it is. And so boom, right there. That was my launch macro side. And so yeah, at this point I'm really content with the trade. I've done so much. I was stopped out on the first trade. I was stopped out on the second trade. Buys didn't change. I still stuck to my bias, and here I am on the third trade, and I've covered literally all my losses that I've taken on the last 2 trades. And that's a W for the day, and move on. Tomorrow, same thing. The next day, following day, the same thing. The day after that, the same thing. Consistency. This could literally be a model. This right here could be a model, because this pans out every single day, guys. This never lacks. The market operates under this basis. Do you understand that? It operates under a script. Do you understand that? And so that's what I'm trying to get to you. That's what I'm teaching. It's really simple. I don't think this is difficult. I think anybody could get this. Anybody who's really dedicated and who's trying to learn these concepts, I think they put their time and do the back testing, offer their own offer their own due diligence I think they could get there. I think they could get these concepts because I really think they're simple. You saw how I walked through you. You saw how I walked you through the bias on how to frame a bias and how to stick to a bias. It's really simple, guys. I think it's really very simple. And I think anybody could get this. And do you see how I'm calling out these market moves beforehand, before they even happen? Notice this is not hindsight. This is not hindsight like everybody else, all these other live streamers. I'm talking about something that I know. I'm talking about something that I've back tested, that I've tape read for hours and hours and hours. And I'm applying that logic that I've acquired throughout all those years. Because I've been in these markets for the past 3 years. Understand that I've been in these markets for the past 3 years. This logic didn't come within a day's work. It didn't come overnight. I had to go through the procedures, the steps to getting to this type of precision. Because I'm telling you, you cannot possibly get this in a single day's work. You cannot. And so that's it, guys. That's it. And so I do hope that you learned something from this. And this has been a really long video, and I've dedicated my time to this. And yeah, I hope you found something insightful out of this. And I'll be seeing you hopefully tomorrow. Today was a good day. Yeah. Till talk to you then, Lord willing.